Do you trust your crypto assets to centralized exchanges that actively sell your private information and front run your trades? Would you like to buy and sell your assets without any middlemen, intermediaries, or robots? Do you like paying slippage, fees, and having the price go up as bots steal from you on low liquidity decentralized exchanges? The solution is nodemarket.io. Set your guaranteed buy or sell price. No middlemen, no slippage, no bots ever. Buy or sell 1, 10, or even 10 million tokens, and you never have to worry. OTC trades are between you and the seller or buyer, guaranteed by audited smart contracts and no human middlemen. Nodemarket.io.
All right. Let's do this one. Let's see. Yeah, I guess that's a good one. Okay. Brian Armstrong. Yeah, happy birthday to that son of a bitch. He's all right. He got stomped by Binance, but Binance got stomped by regulators. So I guess who's the winner? Yeah, hard to say. Okay. Hello, and hello. All right, we got all those knocked out. We'll do a little Q&A, and then we will get into one or two things. One of the one or two is data. Again, I want to harp on everybody how important the data is going to be, especially with generative AI. So I found a piece that kind of explains that a little bit better so that people can kind of put those two pieces together. And then we're going to do, someone had asked to go over this kind of 10x take 20 kind of profit taking. And so just the kind of the overall concept of profit taking in a bullish environment, right? Where at some point you have to take some currency units from the electron space and put them into the atom space. I mean, you don't have to do anything, but I would encourage you. There's a lot of people that have seen their portfolios go way up and then just way back down, and then way up and way back down. Now, it's emotionally treacherous, but if you're willing to just wait it out, you do better than worse. But that's not going to materially change your life. Having a big crypto portfolio isn't going to actually change your living conditions or your ability to help your friends and family or whatever. Or if you have no friends, to get your cats more toys, more bigger and badass toys. You know how much some of these cat condos are? These suckers are expensive. Anyway, so do I think we are in a bullish environment? No. But I think we're very, very close. I still don't think we're in a bull market until we surpass the last bull market. I know that's a weird way to look at it, but I mean, we can be in a bull market when things are going up, but if we're still below the highs of last time, are we really in a bull market, or is it just kind of a bullish environment like what you're saying? So are we in a bullish environment? Well, we still have a lot of things that people are stressed about. They're stressed about the MT Gox tokens, which most that's been resolved, but still there's some of it. They're stressed about FTX. which is not quite resolved. FTX unloaded like 22 or 23 million GBTC shares, like unloaded. And when they hit the sell button, GBTC unwinds that. Then they have to go send Bitcoin to Coinbase and to Coinbase Prime and then do OTC sales. Now, the other ETFs are buying up almost all of that supply. That's why you're seeing, even though there's tons and tons of selling going on, there's also tons and tons, almost an exact equal amount of buying going on, which is pretty crazy. If you think about all of the selling that Grayscale is doing as they unwind that absolute dumpster fire, look how much buying is going on by all the other funds. And I was joking with Brandon yesterday. We were like, well, there's only really a couple ways this works out. Either they continue to sell until there's just nothing left, and basically Grayscale is just a hollow shell of what it was, or they change the fee structure and minimize the hemorrhaging. I think some very, very poor decisions were made at Grayscale, and they are getting their asses handed to them. It's just a mass exodus. In addition to the clients that are exiting, FTX is resolving their bankruptcy. So they have it's a 22 or 23 million shares they've already sold. They have another 8 million that they will have to sell. So about another third of that punishment's coming. But that's less than the previous punishment we got in the last week or two. And to resolve that bankruptcy, yeah, it is what it is. But Sam, so one asset going up is not a bull market. If you look at most of the other assets, they're nowhere near where they were in the all-time highs. And it held 49,000 for about 13 milliseconds. Really what you saw is Bitcoin from about 16.5 to about 44. Because everything above 44 was just moments. And we're right around, we're kind of dancing around the 40K mark. It's not much of a sell-off. So it's definitely not much of a sell-off if you look at the unwind in Grayscale, the unwind in FTX and MTGOX tokens floating around. That's a lot of selling pressure. To have all of it being hoovered up means there's a lot of underlying buying. There's a lot of buy-side bias. So when this is done unwinding, I mean, FTX will run out of stuff to sell. FTX is communism, right? At some point this kind of communist socialist ideas are great, except that you run out of cash, right? Like at some point you run out of other people's money to spend. Well, at some point FTX will run out of Bitcoin, of Grayscale shares to sell pretty soon. And at some point Grayscale will run out of shares to sell because it just won't exist in any meaningful way. There's be a couple lazy people that are stuck there. But I think that thing could easily that thing could get cut in half. And I think these other funds that have more appropriately priced their funds are going to absorb all that. ARK, Kathy Woods ARK is buying their own ETF, which is weird. It's a weird way to prop it. It's almost, it's borderline sketchy, but whatever. Yeah, there you go. Howard, back in the house. What up, buddy? Did we miss you? Yes, Howard. Every moment without Howard is an eternity. It's a damn eternity. So it's and yeah, obviously, Howard, we're glad you're healthy, and hopefully everybody's healthy, or to some degree of healthiness. Everybody who likes Howard, buy a Node Market NFT. Come on, show how much we all like Howard. Anyway, okay, so we'll bring this back. Anyway, at some point, the selling and the hemorrhaging will stop, and when it does, then we get into something that looks a lot like a bull market. And you're looking, I even read a piece that Adam Back wrote, who's the CEO. It doesn't matter. Anyway, he's probably Satoshi, but it's more likely than not that Adam Back is Satoshi. Anyway, that's a whole other thing. But he said he thought it was weird that people, or not weird, but he didn't imagine that people that had been holding Bitcoin in the MT Gox days, that now that we've gone from say $400 to 40,000 on our way to make what he thought was 400,000, he even said that number. Why would they sell out now? Some of them will hold on, right? Some of them won't, but whatever. But most of that's been resolved. So when the MT Gox selling is done and the FTX selling is done and the grayscale hemorrhaging is done, if there's still that buy-side bias left in the market, which apparently there is, like an endless capacity, then it goes up faster than it went down. You're not going to have these three huge entities unwinding forever. I don't imagine you have, FTX doesn't have much more in the tank. I mean, there's just not that much left to sell. They've sold everything. They're taking like floor tiles and kitchen sinks and shit. There's just nothing left. Oh, well, and anything that would be left, the lawyers are going to hoover that up. They're spending like some ungodly amount of millions of dollars a day of depositor funds, by the way. And they'll all sleep well. They're having spent all of y'all's money, like hopefully no one that can hear my voice because we've been preaching against FTX and that dumpster fire shit show for years. But for all the people that got fleeced into that, you should sleep well at night knowing that everybody, every single person that gave money to FTX or that, well, gave money that had deposits there, that a bunch of lawyers, mostly useless, are lighting your money on fire to the tune of something like, I think it's almost $100,000 an hour with all the lawyers. It's something so ridiculous that it makes you puke. Anyway, yeah, I mean, I wouldn't think of it as free ring. It's not free. We're getting them and we're going to give them to the people that get the NFTs, but it's not free ring. And Charlene, that's not going to happen for a while because those rings are just in the prototyping stage. So, and then there's also like luxury versions of them, but I can't say more about that. Those things are top secret. Okay. Let's see. So then, let's see. It's not going away at some point. Yeah. So we're not going to be doing these NFTs forever. So basically, I'll just give you the real quick timeline, and then we'll get back to the business. The real quick timeline is, which, by the way, there's 451 digital investors. There's 55 digital private clients and 1,834 NFTs, which share in 100% of the fee generation by the exchange. So the exchange makes money. That money goes towards, it gets distributed back out to the NFT holders. Yep, that's it. That's it. Okay, so at some point, we will lock up all the IP associated with this. We'll have lawyers look over it that are very clever at identifying and like protecting intellectual property and all this kind of stuff. We'll get all that knocked out. Once that's knocked out, we'll make a decision if we go and look for currency units to explore how you would expand this market. Because we have a lot of things on this market that don't exist anywhere else, like period. So there's probably a lot of value in that. Therefore, at that point, we would probably, if we this would be for sure. If we start entertaining discussions with either larger exchanges or like more deep pocketed investors, then we wouldn't end, but we would stop the NFT sales at that point, and we would just lock it to those people that currently have NFTs. Because new investors probably don't want to come in and have to pay revenue to all these NFT holders above and beyond the negotiation. So anyway, there you go. That's how that would go. So it's not a forever thing. The 10,000 mark we'll likely never get there. So there you go. Is the ring made by No Labs? No, I don't know who's making the ring, but I know that's not them. And there's a couple different companies that we're talking to that would be doing, like, we're getting various prototypes and then, just kind of testing them and doing all that kind of stuff. I say we, not me, just the hypercycle community. We just means I'm one of just like you. us that we are part of all of this stuff. Yeah, there we go. So good. Okay. And then, and yes, at some point, the 100% payout would go away. I would imagine that would be 12 to 18 months from now. And then at some point, once that first group, I think, which was the claimants, were in November. So basically, we just track them. Everybody gets, all the money goes to all the NFT holders. But at some point, that first group will have hit 100%. And then it will go back down to, it's teetering on 22%, but right now it'll be 21%, which is still not bad. Because if you imagine this exchange scaling, then those payouts are pretty significant. So that's good. Yay. Winning. Okay. So there we are. And I think we covered all those details. All right. If we don't have any other questions, we can do either or. It can be we can let you guys choose. We can do the 10x take 20 math, which goes along with the kind of investor mindset. I'd probably go into mindset first and just talk about, why you would take money out of markets in a bull market. Or we can attack data and really kind of look at that first. So it's your choice. Let's see what people want. Whatever you want, we shall do. We can talk data and generative AI. Ooh, data. I like this guy. I like you, Sam. You got your head on straight, I think. Data. Okay, well, looks like data. Okay, so why don't we go into data first? We'll get into the brainiac stuff. So we'll talk about big data, why the data stuff is important. For many of you know that we have been looking at, especially behind the wall for the digital investors and private clients, into the data plays, big data marketplaces, data assets, things like that. The encryption, the protection, the storage of data, the redundancy creation, all that. So that's pretty important. And there's a lot of investment currency units to be made there in and around that. So you just want to be grappling with that. That needs to be in your mind as, hey, this idea that data is a commodity. And if data is a commodity, then you want to own not only some of the commodity, but you want to own the infrastructure. I'm not plan for scaling, lots. Amount that I would talk about in a public forum, none. All right. So there we go. Let's switch gears and get into classroom mode. Ooh, you know what I need? I need a good image for classroom mode. Let me bang around here and find one that would be good for data. What's a good, that's kind of a brain thing. It's got some stuff going on there. Let's see. Look at all that stuff. Look at all that brainiac stuff. Okay, let's go that way.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Okay. First things first, let's get into data. Did I knock out a banner for this? Well, I didn't, but we're going to talk about it anyway. So let's go here. I can make one. Talk data. And then we'll do 10x take 20 math. That way you can hold me to account. Okay. Picked up some storage 8. Nice. Ooh, 51 cents is good. I think I was like 55 cents. But I'm dollar cost averaging into it. So I'll do another purchase here in a few days. Yeah. I like storage 8. I mean, I don't know if it's the best management team, but it's down the list a little bit and it comes up anytime you search for data plays, it does come up. We won't go into the investment side of things, but it's good that you're kind of getting your toe wet there. Those aren't what I would call the stalwarts, but they're definitely in there. People keep finding them, and in a bull market, people will look out past the horizon. And I think that's probably a decent way to look at things. Yeah, I'm not going to do a wall today because this is kind of basic stuff. If I think we're getting into specific stuff, then I am going to go behind the wall. So let's just go, let's keep it casual. Some things to keep in mind, the success of artificial intelligence as we approach artificial general intelligence, it does depend a lot on the quality of data that people are utilizing. It also probably is important, the strategy for data collection, data governance, the sale of data, the anonymization, the various ways you might, like, what do they call it? Not whitewashing, but the ways that you might anonymize or clean up that data so that it could be sold or resold or leveraged, whatever. So in this kind of rapidly evolving landscape of AI, again, think AI as narrow, simple functions, small agent networks, things like that, not generally intelligent, self-evolving, self-editing, self-fixing, thinking, self-coding agents. That's the AGI side. We're on the AI side. So, and it's going to be a bumpy path, but the buzz around generative AI, obviously you're just everywhere. Generative AI, oh my God, Lipton iced tea, generative AI. Holy shit, I got to drink some of that. So companies are kind of flocking to adopt this technology. I mean, most of it is companies just stapling on other AI fixes and other, other services that other companies do. But there's this big, like, mass flock to adopt AI technology as we approach AGI. There's over a 1,000% spike in AI adoption since after this time last year when ChatGPT kind of first popped out there. And remember, in that first month, they got like 100 million. This is the fastest onboarding experience in human history of any new technology, like in human history. This thing, it went faster than disease, right? It spread faster and got into more computers than the Red Death did. So there you go. You know about hygiene back then. Anyway, but amidst kind of all this excitement, people, they're thinking AI, but they may not be thinking data. They will be thinking data, but they're not right now, not so much. So I think most people here have an opportunity to kind of front run the beauty pageant by a fair amount. So the hype around generative AI, obviously everybody's talking about generative AI. Businesses are trying to embrace the technology. They're trying to implant it into their apps. They're trying to shower you with, like, hey, look what we do, man. We're doing all sorts of AI stuff, and you can too if you use our widget. Anyway, and people are being kind of enamored with these ideas of generative AI and like it touching all of their systems, which it will, touching all of their systems and equipment and tech and all that. But what is underneath all that? None of this stuff works without data, like none. And not just data, but quality data, so that you don't have these systems that hallucinate a bunch of spammy bullshit. That's not going to make your decision making in life any better. So AI, the I, intelligence without quality data, is like a car that has no fuel, right? So, and this seems like a basic concept, right? It's crucial that you kind of dial this in. Bad data is bad AI. It's just right? It's just artificial. It's not intelligence if it's based on crap data. And so it's having the right data and monitoring the kind of the efficiency of the input and export of that data, and making sure that the quality is maintained. And now they're getting into synthetic data and all this kind of really crazy stuff. So the race for this kind of AI to AGI glory, the quality of the data, where it needs to be the most important thing, tends to be kind of a second or tertiary thought. Like, it's like, oh yeah, the data, it's like a little bag of trash down, but no, the data is the most important thing, right? And amid all of this excitement, there's this very messy data integration element into these systems, right? And the governance of that data is kind of, not really a first thought. And companies are all trying to acquire data. I want more data. Like they're buying up, water rights and things like that. But it's structured and unstructured data. And so the focus on quantity right now is what companies are doing. They're not yet focused on quality. And this is where you, like as an investor, you can kind of get a jump on these people, because as this rush for data, at some point people are going to go, crap, all we've got is a bunch of junk. Okay, now let's refine this and get good data integrity and some governance system. In synthetic data, yes, it means what it sounds like. It means generating data that is not necessarily, that hasn't come from natural processes, inorganic data that's based on natural processes. So we'll get there. Just hold your horses. Hold your virtual horses. Anyway, natural language processing is a cornerstone of AI, and so it has applications with a bunch of use cases. One of the concerns in natural, by the way, there was someone who's like, NLP, that's the way you hook up with chicks. I'm like, no, that's neuro-linguistic programming that a bunch of kind of almost felons teach people how to like pull people at bars. No, that's not this. This is not that. This is natural language processing, right? Which will probably not get you any more sexy time. Anyway, the concern is that we are overestimating our readiness when it comes to data quality for neurolinguistic, for natural language processing. And so while we have structured data pipelines that are being formed, and we have these little kind of marketplaces that are being formed, it's crucial to ensure that the underlying data that's being sold and marketed is accurate and reliable. If you have bad data, nothing that pops out is useful. And no, Tracy, don't think of data. Don't think of inorganic data like synthetic data is fake. Imagine modeling a system. You have a biological system, a closed system in a fish tank. You have a little biodome, and you can perfectly model all of the interactions. There's just very few, and you can perfectly model them. You could use kind of these predictive systems, because you know what the rules of math and science are in this closed system. You could run a bunch of synthetic experiments that, simulated experiments that never actually happen in real life, because you know exactly, or at least with a high degree of certainty, what those physical rules and constraints are. You know the rules in this frame, like your game theory, right? You know the incentives, so you can generate outcomes that are accurate as long as you can dial down, like to the subatomic level, all of the particle interactions. The closer you can get. This is why quantum computers are so interesting, but also so difficult. In order to rule out quantum effects, you kind of have to operate these things at like negative 273 degrees Celsius or like 0 Kelvin, close to, because any amount of temperature exerts like these kind of forces on these systems which pervert the data, right? So you have to be able to freeze out all of the other bad information, and so what's left is good information. Anyway, the point is, if you can correctly model a system, you can correctly export simulated data. Make sense? So, which is cool. And that's how we're going to really, like, that's what a lot of the medical stuff they're doing right now with like folding proteins and stuff, is because they have correctly modeled these systems. Now in simulated environments, they can do all sorts of really cool stuff. And the data it's accurate to real world experimentation and results. It's cool. So generative AI not only relies on data, but it also reshapes data governance, right? So it introduces these new challenges, some and opportunities that need to be considered. One, intelligent data quality. 2, synthetic data generation. We'll talk about that in a second. 3, data governance policies. And then modern monitoring and resolution of data. Yeah, this is kind of an Oppenheimer moment. It's pretty cool. Anyway, AI can identify missing data, but is it to the point where it can truly comprehend context? Well, I can tell you right now, it couldn't read a PDF I had of furniture. So we're not there yet, right? I mean, it could do some stuff. It was funny. It could count up how many mirrors were in the house and how many, like stuff like that. But it would miss, like when I said, what are the sizes of all these chairs? It was like, well, we can't figure that out. I'm like, well, you could just look right beside the name of the furniture and there's the size. But anyway, we're not there yet. So the risk of, you could say, okay, you have data goes in, data goes out. But if it's trash goes in, trash goes out. Or what they call it, GIGO, garbage in, garbage out. And that's a concern, obviously. So relying solely on AI to assess data quality without human oversight right now leads to erroneous results. In the medical field, that is tightening, seem very narrow, where you're getting to the point where the humans are the garbage in, garbage out, and the AI systems that assist them are the ones saying, hey, you missed that, or hey, you missed this on this x-ray. So, which is good, because at least on the medical side, we're making a lot of strides. Okay, so then you have the issue, like we talked about, of synthetic data generation, the concept that AI is generating data for other AI. Sounds like a weird kind of loop, right? But it does raises questions about the idea of an echo chamber, which is a valid one, where AI is self-reinforcing existing biases or limitations to the data that it's not only trained on, but generating. And that's where it gets back to, you have to go back to like beneath first principles. You have to go back and know that your model, that your rules in that system are correct. Yeah, otherwise, kind of like you said, everything's a hallucination, right? If your data is hallucinated, everything's a hallucination. And so you got to reduce everything down to like the quantum level, which is, we're not there yet. What, 20 qubits or something is the best data. Anyway, whatever. All right. So then you have the issue of, let's say you can spit out good, synthetic data. So you have these pools of synthetic data, which ultimately will generate much more data than the current available data from like human experimentation and collection, right? We know this because when you can spin these things up in virtual environments and you can truncate the time, because time is just a math issue, you just move some decimals around, then you can spit out tons and tons and tons of valid, again, if you've zeroed out quantum effects, of very valid synthetic data. There will be more synthetic data than real data. This is just kind of an obvious. Anyway, then it becomes important data governance. So the idea of AI guiding policies, that people are like, oh, you could go to AI court or whatever, and AI will, which that sounds maybe futuristic and dystopian, but it actually would be better than getting a judge on their bad day that has a lifetime appointment, that may or may not get bags full of money at 3 a.m. to look this way or that way. Humans are fallible creatures. Therefore, you could imagine a more just system that is kind of, there's all sorts of things you could imagine that would be better if, humans weren't the ultimate decision makers. But anyway, it raises the possibility of first, like being very skeptical and then being over reliant on technology. Sometimes where you're like, oh, trust the box. Well, it's telling me to drive off a cliff. Trust it. Trust the technology. I always say trust the technology until it starts to fail, not until it fails you. If it fails you, you drove off the cliff, until it starts to fail you. Anyway, and so there's a balance between AI-driven policies for governance and human judgment. And then finding that balance is going to be very crucial to avoid unintended consequences, down the road. We get this. And then finally, you need the monitoring and resolution side of these systems. So if AI has the ability to self-correct, that's great. But what happens when AI makes mistakes? Again, they're not all mistakes are hallucinations. Sometimes mistakes are simply just processing errors. It's not hallucinating new ideas based on weird data. Sometimes it's just interpreting the world wrong. And a lot of that is our ability to monitor, like in real time. These systems will get better at that. But there needs to be some avenue for human intervention and oversight to rectify errors. Does that make sense? So you have this kind of AI strategy versus data strategy. And in this AI world that we're all in the AI world now. There's no one's not in it. There are people that are not in it, or I don't know, they're on the sidelines, but they're still in it. They're still being affected by the world changing around them. Like, it's like if you're on a planet and there's some like pandemic going around, say there's a pandemic going around, you're in it, whether you choose to be in it or not. You're in it. Anyway, data strategy and generative AI are like this kind of back and forth, kind of like dancing partners, whatever. But somebody can step on the other one's toes. So AI is a powerful tool right now. It is getting more powerful. It's not a magic wand. There's no magic behind what AI is doing. It's using data, some of it quality, some of it not, and making inferences and predictions based on data. Again, good and bad, garbage in, garbage out, quality in, quality out, right? But even quality can start to be perverted if it goes long enough into echo chambers. So for us, we have to just remember that these are all considerations. These are all things that we're going to have to think about as we move into a world that is reliant on AI systems that are reliant on data. And the quality of that data is going to become more important, I think, than the quantity of the data. And from a qualitative standpoint, you as, Joe Sixpack, the investor, that's where you can win, right? And that gets back to quality projects. But now you have to think, okay, it's not just a quality project, but when I'm doing my 5 T's, looking at the team, the timing, the technology, on that technology question, you want to be, very diligent in seeing if they have systems in place, especially these data aggregators, marketplaces, things like that, that they have systems in place to ensure quality in, quality out, right? You want to be able to wrap your mind around that. Okay. Are we good there? That's a little bit of brain food. Now let's switch gears a little bit. Let's do some 10X take 20 talk. And we need to think about how important it is. Matter of fact, let me change that banner. Let's just get past this banner. We'll make it a different banner. So the 10X take 20 rule is something that we've had for a long time. Some people have adhered to it. Some people have not. But let me put it on the screen just so everybody's clear. Here is the rule. When an asset, we will call that N, reaches 10X, 1,000% increase in your DCA price. What is that? That is the dollar cost averaged price. That is the average aggregate price you paid. If you paid first 20% at 1 penny and 20% at 2 pennies and 20% at 3, 20% 4, 20% 5, your DCA price is 2.5 cents. Okay, because you got 20% from 1 penny to 5 pennies. Make a sense? Okay, good. So it's the average. And from your average price, if you get that 10X, you immediately do whatever the hell you want. But I would immediately, dump, sell, offload, exit, swap, trade, get out of 20% of the total of this N asset. This assures a 100% return on investment. Okay, right? Because you got your original money back and you got a double. The universe can never take it back. Does that make sense? You win. You win forever. You also don't take so much off the table that you deplete your ability to potentially participate in some kind of logarithmic scale to that asset. You had a 16X, you didn't take it? Sam. Well, you held out. Good for you, but you got to stick to the rules. Okay, so what do you do after that? At that point, every time after that, it's the 2X take 10. So 10X take 20, 2X take 10. Every 2X after that, when that asset doubles in value, which is a 200% increase from your last sale. So if you sold, remember, we had the tokens that we bought and our average was 2.5 cents. at 25 cents, we would have deuced out with 20%. And then if we got to 50 cents, which is a double, we would have deuced out with 10%. And every double after that, 10% off the table, 10% off the table, 10% off the table. Okay? Every time. That ensures a gradual 180% return on investment based on your last sales point. Say, okay, why would I do all this? Well, you would do all this so that you can actually lock in profit. And in a bull market, and I'm going to do two things. I'm going to do one, I'm going to talk to you a little bit about it. And two, I'm going to throw up the 10x take 20 hypercycle chart to show you. Because I know a lot of people, they think about this like, damn, but what if it goes to $10? What if it goes to $50? I'm going to lose all that. No, not going to lose nothing. It's a minuscule part of your portfolio, but you'll continue to expand your balance sheet. Remember, you got to make your life better. That's the whole point, is make your life better. So it's not profit taking. This is like smart, conscientious profit taking in bull market scenarios. And we all know Jim Cramer's a damn fool, but his little maxim, his little saying, there's a bull market somewhere. That's true. There is an asset somewhere that's undervalued, or many. You just keep finding them because you're diligent and you do a little homework. Then you're always going to be in a position, not always, but many times a year, even in terrible markets, many times a year. Listen, yeah, last year sucked, but tons of us took we had several assets that had 10x take 20s. Newnet, Fetch got one, AGIX got one. There was a handful. People made a lot of money in that dumpster fire market last year if you were paying attention. Anyway, okay, so imagine a market climbing, from where we are, we're, 1.5, 1.6, 1.7 trillion. We get back to our old all-time highs around 3 trillion. We go to 10 trillion, right? Your investments are like pew, 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 multiplying. And this is what happens in a bull market. We're like, oh my gosh, it's like being at the very top of a swing, and then the swing just freezes. And you're just like there for a long time. It is crucial to recognize the difference between market optimism and stupid fantasy. Okay? And so today we're going to focus on consistently taking profit instead of waiting for some perfect moment that's probably never going to come. So everybody's going to have, a bull market to me means we get to our all-time highs again. Essentially, a bull market is a period of increasing market prices reflecting strong economic indicators and investor confidence. Now, if you look at the macro picture in the world right now is not good. It is dumpster fire. Matter of fact, we would have seen all this chaos in 2020 if not for COVID and all of these stimulus packages that went out and paid people to sit at home and trade on Robinhood and do stupid shit and buy stuff they can't afford and buy cars they're going to have to get repoed and all this we get it, all this bad behavior. So if the macro picture is bad, you at least have to consider it. But in the micro of the crypto space, you could have bad macroeconomic information, but have good, economic powers at work, both in the completely scammy informationless stock market or the chock full of information debt yield curves, or in a smaller illiquid asset space of illiquid assets on illiquid exchanges traded by sketchy ass individuals like crypto. So if you have overwhelming investor confidence and you have increasing market prices, then it's a high likelihood that you're in a bull market. The problem is that people fall into fantasy. And the fantasy trap is this expectation that this time is different and that there's endless growth. This is going to keep going forever. Yeah, if you extrapolate assets out 100,000 years, but no one here is going to live 100,000 years. Even if I do, you guys won't know it because you guys will all be long gone. So for discussion's sake, it's not important. Anyway, what happens is people hold on to assets too long. They're too good at pleasure delay. driven by this illusion, this fantasy of ever increasing greater gains forever. And then they don't ever take any currency into the sideline. So they don't ever take anything out of the electron space into the atom space. They don't ever meaningfully change their life. So what is the point? So you have to balance the two. Delayed gratification, pleasure delay, those are extremely powerful tools and you need them. But at some point, you have to pull the little thing when you're playing those spinning fruit wheel things in Vegas. At some point, you have to take you have to cash out and take your damn quarters and go do something, go to the buffet. I don't know. Anyway, so you have to be just greedy enough, right? Like, what does Einstein say? Things should be simple, but as simple as possible, but no simpler. You need to be greedy, but conscientious, right? And there's this fallacy of infinite growth, right? One, don't believe in the fallacy of infinite growth. Two, don't be an emotional investor. And three, understand opportunity costs. So the fallacy of infinite growth is, history shows us that markets don't rise indefinitely. They also don't crash indefinitely. Like, things cycle, right? And not taking profit can lead to missed opportunities, and it can lead to losses because then sometimes the information changes. If you took profit on XRP when it was at $3, you crushed it. It may never get to $3 again. There's a really good chance. No one wants to hear this. There's a really good chance that XRP and some of those assets that had their 2017 run, that they don't ever go up again. Like, ever. Bull market, no market, nothing, ever. Right? Sometimes technology passes you by. Sometimes, you get into court for 3 years and the whole world finds out that you're a bunch of dirty mofos that sell tokens to line your pockets. Brad Garlinghouse, Chris Grand Larceny. So sometimes the opportunities go away, right? The technology is no longer interesting. The world just moves to other tech, or the technology is shared by all these other companies. Nothing you do is that interesting. So you can sometimes you're not just waiting for the next time it goes up. Sometimes there's no next time. And if there's no next time, then taking profit off the table is even more important. You're just harvesting gains, right? What tends to happen is that decisions you make that are based on greed tend to lead to more regret. You want to do as much as you can and base it on math, right? And this, get away from emotional investing and, again, be more game theoretical, more pragmatic. Profits only become real when they are realized, right? And everybody says, well, I want to wait until this. I want to wait until that. No, you got to have a system. Holding out for higher gains ties up funds that could be used elsewhere, potentially in other better opportunities. And that gets into a lot of the cognitive bias about the fallacies we have about assets that maybe they haven't performed this well. They're like, well, the next time it gets to here, I'm going to do this. And it starts to go down and down and down and down. Like, okay, once I get back to break even, I want to get to even. What difference does it make? If getting back to break even is harder than some other asset going up, if you have $10 here or $10 there, you put $10 where $10 is going to do the most good. Just forget the emotional part. Forget it. So profit-taking strategy, essentially, when you realize gains, actual profits come from selling, not holding. Okay? This ensures that you benefit from your investment decisions. That is the whole point of all this, right? I've been waiting. Listen, man, I've been a renter forever. Because I was like, I'm not going to buy anything unless it's so badass. I'm just not. I don't care. So I've been a renter my entire life. Didn't care, didn't bother me. But that was part of a specific strategy so that at some point, when all the ducks lined up and it made sense, I would get a place. But until the boxes had been checked, but this wasn't an emotional decision. This was just a math decision. That's it. So have a strategy, stick to that strategy, ensure that you actually benefit from your investment decisions. Regular, systematic, rules-based profit taking aligns your portfolio with your risk tolerance and with your goals, especially in very like volatile and dynamic markets like crypto. So setting goals, 10x take 20, 2x take 10, staggering your selling in the same way that you stagger your purchases, right? Establish clear profit targets for selling portions of your holdings. Sell them in increments. Don't just deuce out all at once. I mean, you can, if it's your dollar cost average exit. 10x take 20, 2x take 10. But even those, if it's a big sale, like if I had 1 million tokens to sell, I wouldn't do it all at once. I would be like, here. So the main takeaway from this, and I'm going to throw a chart up here in a second, but the main takeaway is you have to take profits in whatever bull market, macro or micro, that you find and that you're investing in, right? That's just competent, wise management. You have to imagine managing your money. You're managing other people's money. When you think about it that way, you're like, oh God, what would I recommend somebody else? You're like, well, I've got a lot of risk tolerance, but maybe grandma doesn't. So you have to secure gains. You have to maintain a balanced portfolio. And that's not like a lack of faith in the markets. It's nothing like that. The goal is to turn all of this market optimism into actual financial success for you, right? And in investing, the real win is not just making money. The real win becomes keeping it. Well, and then using it, right? So none of this stuff is done just by staring at your portfolio. Yeah, in a sense, we are all renters in the long run. But you know what we get to do? We get to rent a lot more if we have continued rules-based success in the way we kind of slowly exit out of our portfolios. And again, this doesn't mean exit out of everything, but as you shall see, bam. So what we've done here is, this is just a hypercycle example. I'll go through it real quick and then we'll call it a day. But how are you going to do that when the hypercycle, when it's married? Well, because you're going to be getting paid, treasures, you're going to be getting paid all the time from the nodes. Those nodes are paying you part of the compute revenue. You're getting paid all the time. You won't even have to think about exiting. You don't need to exit the token when you're just getting paid for compute. You basically you just started a business, my man, or female or pronoun. Anyway, so here you'll see. Here's a breakdown. If you had made an initial investment of $5,500, okay, which again, for some people that's a lot, for some people that's not. It doesn't matter. It's just the point of this mental exercise. These are the hypercycle exits one would take. You have 100,000 tokens. You got them at 5.5 cents. Yay, investment. At 55 cents, which is the 10x, you're going to take 20%. It's easy. 100,000 tokens. I sell 20,000. I put 11,000 bucks in my pocket. Look what I just did. I just got a double. The universe can never get that back unless I'm a dumbass and I give it back. Okay. I'm only left with 80,000. Great. When's my next exit? At a double. So when this 55 cents has doubled to 110, guess what? We've hit both of these. You guys realize this, right? These have already been hit, both of these. And there's a lot of people that were in the 50, like all the way from like 5.5 to say 7 cents in that range. Okay. Even some day oneers got like 30 cents. Okay. And even below, I know some people got 210 and all that. So, but point is, you have 80,000 tokens left. It hits $1.10, which again, it did. You sell 8,000. You put another 8,800 bucks in your pocket. So even just net, so already with what's happened, already, you're at 19,800 bucks, basically 20,000. You're pretty much locked. You've almost locked a 4x, 400%. This is less than a year, by the way. Okay. So what's the next mark? $2.20. We're not there yet. Where could we get? So in my mind, and again, I'm not telling anybody to do any of this. I'm just telling you where I think we probably level out. Somewhere between here. Somewhere between 4 and 8 is what my gut instinct tells me is hypercycles. Now, could it be more? Yes. Obviously, things don't go in a straight line. Things could be spazzy and go crazy. But my guess would be in this range. So people are going to get, in my opinion, 2 or 3 more big exits. So you have 72,000 tokens left because you remember you sold 8,000 of them. 72,000 tokens left. It hits 220. You deuce out with 10%, right? Because every time it doubles, you take 10. So that's 7,200 tokens. There's another 15,840. Let's go through the list. You have 64,800 tokens left. We get to 440. You sell 6,480 tokens because that's 10%. It has doubled the price. $28,512. You have 58,320 tokens left at $8.80, which again, I think is possible. You sell another 5,832 tokens. Again, that's 10% because it's doubled. You're cashing out another 51,321. And if the AI gods smile on us, we have 52,488 tokens left. If we get one more double, that's $17.60, which of course it could go. I mean, who knows? There's no rules. I don't know anything about the future more than anyone else. I'm just my own gut feelings. We hit 1760. You're going to sell 5,248 tokens, which is another 92,300. So listen, Linda, listen. Your $5,500 investment has returned to almost $208,000. Think about that for a second. $5,500. Why? Because you were patient, but you had a rules-based exit strategy. You have to have a rules. How does taxes affect it? You pay your taxes. Who cares? If you've held the asset more than a year, those are going to be at whatever the tax structure is, but I think it's still, that would be long-term capital gains. Right now, I think that's 15%. But yeah, that's immaterial. If you're paying taxes, it's because you're winning. Oh, that's good. So yeah, up to 880, you're at 115K on a $5,500 investment. Holy moly. So, keep that in mind, peeps. I mean, my guess is we're already in the 110 to 220 mark sometime in March. And again, this is not a prediction of anything other than just my gut feeling. The only reason I say that is because compute starts and tokens are going to leave supply quick. But this is not that. This is more a behind the wall discussion. I'm not going to get into that. But anyway, so are these all possible? Yes. Yes, they are all possible. Every one of them is possible. Most things are possible. Are they feasible? Are they probable? I think up to 880 is feasible, probable, and in the next year to 2 years, likely. 17, but I don't know. I mean, I don't know what the world's going to look like. And all this is also not considering any kind of inflationary effects or debasement effects. So that's the other thing. You got to reduce all that. You got to reduce those macro effects out. Because you'll just go off on weird tangent, hallucination, whimsy stuff. So, but the long story short, having a systematic approach, it still leaves you, look at that, from your 100,000 tokens all the way to the bottom, you still have more than half left. So it's not like you don't get to participate. But do you want to be the guy leaving all that on the line? Let's say it only gets to 440 and then goes back down to $1. You still cashed out, let's see, 30, 45, 55, 65, almost $66,000, 65, 66K on your 55. You still did an 11X. So no. I mean, yeah. I mean, you've still pocketed 11X and you still have your investment, like 65% of it. So anyway, nope, I'm not saying anything. Anyway, will compute be paid? As far as I understand now, it's going to be paid in USDC, but I mean, I guess it makes no difference. You can swap one for the other. So you could some people will probably try to get paid in hypercycle, which will eventually I'm not going to get into all that. That's a whole other thing. Let's call it a day. Anyway, we'll see you tomorrow. Stay in school. Don't do drugs. Don't do anything my poor insolvent drunk struggling on meth grandmother would not do, which is very little. Brandon, don't know if he's wearing sleeves, but I'm going to guess he's not. Investor weekend is March 15, 16, 17 for those with let's see, it's 50 and 100. If you have 100 of the NFTs, you actually get you're there. You're there. If you have if you're a digital private client and you have 50, you're also invited. So that should be a lot of fun. That'll be a full weekend of stuff. And by the way, it looks like Tufi is going to be staying with us as well during the investor weekend. So it'll be kind of fun. Like go down the hall to the third bedroom on the left and go ask Tufi that question. I can't answer it for you. That's gonna be a lot of fun. Anyway, we'll see you tomorrow.
Are you tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com. Are you tired of all the uneducated?